In 1929, the Dow Jones average had been almost 10 times what it had been at the end of World War I. Stocks were rising rapidly. Prosperity seemed everywhere. Corporate profits were at near record high. And if wages were trailing a little bit behind, nobody seemed that worried. Workers even were investing in the stock market, investing in real estate. So there were other opportunities for making profit, for making huge gains, for becoming not just prosperous, but incredibly wealthy. Nobody was worried, it seems, of an impending crash. But the crash that followed would be one of the most consequential in the history not just of the American economy, not just of the global economy, but of world history as a whole. On October 24th, 1929, the stock market opened for the day and immediately prices began to plunge. Nobody was quite sure why they initially began to plunge, but once they did, it seemed that there was no stopping them. And by the middle of the day, when trading was suspended, they had fallen a full 11% on almost unprecedented volume. There were rumors of dozens of suicides by stockbrokers and others who had borrowed heavily in order to buy stocks on margin. Now, what usually happened in a circumstance like this was that banks and big investment firms got together and effectively guaranteed that there would be buyers for all sellers, that every stock that was offered would find a purchaser, and this generally supported the price and stopped the momentum of a fall. What made it different was that when they did that, this time in the last week of October 1929, it had no effect. The market began to plunge. And soon it became evident that the big investors were not even trying to stop the price fall. They were simply trying to get out without being crushed themselves, although many of them would also go bankrupt. The effects began to spread throughout society. As people who had borrowed heavily, business owners and others, faced calls for money to pay back their lenders, they had to let employees go. They fired them, they laid them off, they closed plants, they closed stores. And as they did so, workers no longer had wages, they couldn't purchase, and so the price fall began to continue, the price fall and the wage fall. Unemployment rose rapidly. Soon, by 1932, it would be, by conventional measures, 25%, but more accurate measures would probably have ranged even higher still. And the ripple effects spread out not just throughout U.S. society, but throughout the industrialized world. In Western Europe, bank after bank collapsed, producing financial instability, in some cases hyperinflation, that would prove very difficult to eradicate. Unemployment also rose in those societies, and social instability began to rise as well. People throughout the Western world stopped getting married. They stopped having children. Birth rates dropped tremendously in this period. Crime rates rose dramatically. And even bigger crimes would be the product of the social instability that resulted.